Hello everyone, and welcome back to another video. This is lesson 3 of the Macro Power of 3 development program. And we discussed in the last lesson a bit on significant inefficiencies, and you guys also have your significant inefficiency checklist inside of RTO Discord. But we're going to look at how we can utilize time and price to understand algorithmic price delivery utilizing these significant inefficiencies. So getting right into it, here's a reminder on what we discussed in the last lesson. If you guys forgot to write this down or save this, make sure you guys write it down now, pause the video, and note every single one of these significant inefficiencies. Okay, 930 fair value gap, news fair value gap, new week opening gap, new day opening gap, macro BPR, macro inversion, high probability inversion, high probability order block, and high probability fair value gap. So first, we're going to talk about how we can utilize the 930 fair value gap with macros. So the terminology that we're going to use throughout this lesson and in future teachings and just in the totality, the entirety of RTO's future is roadblock number 1. And then we'll also look at reference points. So the 930 fair value gap as a roadblock. We're going to get into chart examples, but for this, the main thing with the 930 fair value gap as a roadblock, when we are bullish, we want to see a close above the 930 fair value gap after the macro power of 3 has taken place. And when we are bearish, we want to look at a close below the 930 fair value gap after macro power of 3 has taken place. So let's start to visualize what we discussed in the previous slide, the 930 fair value gap as a roadblock. So we're going to use one of our entry methods that we've discussed in previous videos. And in this example, we're discussing the macro inversion, and we see here depicting the macro power of 3 concepts, right? It's a bullish example. Price goes below macro opening price, sweeps some form of sell side liquidity, and then reclaims that SIBI, classifying it as a macro inversion. And we have our buy side liquidity target. So when we've established an entry point, the macro inversion, and we've also established our target, our buy side liquidity pool, we have to look at what's in the way between those two things. So when we have the 930 fair value gap, I view it as a roadblock. What do I mean by that? Price has to close above it to give me confirmation that my buy side target is going to be met, because I know the significance of the 930 fair value gap, and I know that the bodies tell the story. So I want to see a candle close on the 1-minute chart, because that's where we execute, above that 930 fair value gap. And then I want to see it support price and push us higher towards that buy side target. And also notice this is occurring during the macro window. Okay, so anything that occurs during the macro window is of higher significance to me. As we continue, this is very important. When we get that close above the 930 fair value gap, it's not only confirmation that it's likelier that we're going to continue to our buy side target and that we're correct about our analysis and our trade, but since we want this 930 fair value gap to support price, once we close above the 930 fair value gap, closing above that roadblock, we can move our stop loss to break even. So that's the rule. Once we close above this, you move your stop to break even. So if our stop loss was initially down here, below the swing low, below the macro inversion, our entry method, once we close above the 930 fair value gap, we trail our stop loss up to even, risk is reduced, and then we let the trade play out and we deliver to the buy side target, right? So let's look at an example of this in an actual chart setting. This is another bullish example, and this is NASDAQ's 1-minute chart. All these examples will be on the 1-minute chart because that's where we execute. So bonus here, we have an SMT, and you'll see additional signatures throughout not only this video, but the entirety of the lessons throughout the Macro Power of 3 program, okay? The point is to kind of just continue to develop your repertoire of being able to identify these algorithmic signatures and build a narrative, and then you know the basic framework of a Macro Power of 3 setup, okay? So here, for this example, we have a target, opening range high, a session high, and we have your 930 fair value gap, the first fair value gap after 930's opening price. Okay, price goes lower, uses the 930 fair value gap, but look at right when we enter the 950 macro right here, this purple line is your macro opening price. Price goes below, sweeps this low, referring to a discount inefficiency. So this can be an entry here, your balanced price range. And then we expand higher, and right here close above the 930 fair value gap. So see how from our entry point, the balance price range high, to the target, the opening range high, there is the 930 fair value gap acting as a roadblock. It's in the way between our entry and our target. We need to see a body close above that to confirm to us that we're more likely onside and to allow us to reduce risk to even. Okay, so we're doing a responsible thing. As soon as the bodies tell us that it's responsible to trail our stop loss to even, we're doing so. Okay, and then we just read price. Even if it comes back and stops us out at even or runs to our target, that is what we do. Okay, we know how important and how powerful the 930 fair value gap is, so we need to see a body close above that. Continuing now, let's look at a bearish example when we have a 930 fair value gap as a roadblock. Using the same setup as before, just flipping it, you have your macro power 3 above macro open. We sweep some form of buy side liquidity. We have a macro bearish inversion. And then between our entry point and our sell side target, we see a 930 fair value gap. We need to see a candle close below that as confirmation we're onside. And once that occurs, just like the bullish example, we move our stop loss to break even. Okay, so let's look at a chart example of this. And again, ES 1 minute chart, we see sell side liquidity. We see the 950 macro here, and that is what we are focused on for our entries. Okay, so we see price come down, right? Expand higher above macro opening price. And I mentioned the previous example, there's going to be some additional signatures. Note how we already had a liquidity sweep here, but here we are referring to right at the start of macro open, a premium PD array, that is this order block here. And then after we have that expansion above macro opening price, we close below the macro inversion, open up, wick back into it. That is our entry. Our stop loss is above the swing high, above the macro inversion. And we're targeting this sell side liquidity pool. Now, just like the previous example, this 930 fair value gap is in the way of our entry and our target. So once we get that candle closed below the 930 fair value gap right here, we move our stop loss to even. Risk is reduced, and we just wait and see if our target is going to be met. So we discussed the 930 fair value gap as a roadblock. Let's discuss the 930 fair value gap as a macro reference point. When we're bullish, we want to see price refer to the 930 fair value gap below macro opening price before providing us the setup. When we are bearish, we want to see price refer to the 930 fair value gap above macro opening price before providing us the setup. So if we visualize this, this is what we are looking for. We have macro opening price, price goes below it, sweeps liquidity, and refers to your 930 fair value gap before offering us a setup. Okay, so if I actually refer to the previous slide, you have kind of that balanced price range formation here, and then we have our buy side target. So before we were looking at how price needed to pass through the 930 fair value gap as a roadblock. Now we're looking at it as a reference point, how it's going down to deliver to that 930 fair value gap below macro opening price before expanding higher to a target. So if we look at a chart example of this, we have our 950 macro on a NASDAQ 1 minute time frame, and we have macro opening price. And note how right at the start of the 950 macro, we spool below, we sweep some of this lower time frame 1 minute sell side liquidity, and we're referring to the 930 fair value gap, the first fair value gap after 930's open. And then we start to expand higher. For a bearish example, we're looking for the same thing, just flipped around. We want to see price go above macro opening price, refer to that 930 fair value gap, and then expand to a sell side target. So if we look at an example of this in the charts, we see again the 950 macro, NASDAQ's 1 minute time frame, and we see macro opening price. Price is coming back above that to run a swing high and refer to the 930 fair value gap before expanding lower. So let's talk about how we can utilize the news fair value gap with macros. We're going to utilize the same terminology as before. We're going to look at how we can utilize the news fair value gap as a roadblock. When we are bullish, we want to see price close above the news fair value gap after a macro power of 3 setup. When we are bearish, we want to see price close below the news fair value gap after our macro power of 3 setup. So if we go to visualize this, similarly to the 930 fair value gap examples, we see macro power of 3, and then we see the macro inversion, and we see a news fair value gap in the way of our buy side target. So the same logic is applied here. We understand what is significant, and in this case, on this specific day for this specific example, we have a news fair value gap in the way of our target. Once we get a candle close above that news fair value gap, that's confirmation that it's likelier that our target will be met, and we can also reduce our risk to break even. So let's look at an example of this in the charts. We have a 2:50 p.m. macro. You see macro opening price. You see price spool below that key opening level, sweep sell side liquidity, close above this SIBI. This is your macro inversion, and that is your entry. Okay, now it's not depicted here, the exact candle, but this is your AM session high from that specific day. So we're targeting a session high, which you guys know are my favorite targets. But we need to understand, beyond just this chunk of price action, is there a significant inefficiency in the way from our entry and our final target? And today we do have that. This was an FOMC day. So we have a news fair value gap. Once we close above, that's confirmation that we're likely on side because the bodies tell the story, and we move our stop loss to break even. Okay, so if we continue forward for a bearish example, we look at macro bearish power of 3 setup, news fair value gap in the way of our sell side target as a roadblock. We want to see us close below, confirmation, and move stop to break even. Let's look at an example of this in the charts. 950 macro, price is going above macro opening price, and that is this doji looking candle here. I just dragged it out to the left. Typically I'll drag it out to the right, as you guys have seen, just because it would have been a bit blurry in this kind of chunky price action, right? Here we see macro opening price. Price goes above that key opening level, sweeps buy side liquidity. That checks out, right? And now this is where you have to be objective. Okay, see how we have a BISI here followed by a SIBI. This is your macro BPR. Okay, price chops around, and this is your entry initially. What's the rule for stop loss placement? Above the swing high here. So here you have some drawdown, right? This is not ideal, but this is why sometimes you give your stop loss room to breathe with this swing high above, right? So yes, we get above it, but look what happens when we close below. We open up, wick up into it, and see that initial signature of weakness that we wanted to, and expansion away, right? So quick note on this, the focus is on the news fair value gap as a roadblock here and significant inefficiencies for this teaching. But this is going to be called the 2-chance rule. I will expand on this in a separate teaching where I will specifically talk about it and how we can actually implement it as a specific model. But when we have price close above a significant inefficiency, our entry method here, our macro BPR, and then we close back below it, then I want to require the speed that I initially wanted to. So I'll talk about this in depth in a further teaching, but for now, see how we close below, used it to propel price lower, and we're targeting our opening range engineered sell side liquidity. See how these are relative equal lows, but what's in the way? An 830 red folder news fair value gap. So once price closes below, we want to see it push price lower and confirmation that we're going to see our target met. And we also reduce our risk to break even. And our risk is off the table, and we can solely focus on price and let it play out, knowing comfortably that we don't have any risk on the table. And we did it with repeatable logic here. Okay. So if we move forward, the news fair value gap as a macro reference point, just like the 930 fair value gap, we look for macro power of 3 concepts. But while we're going below macro open, we want to see it refer to that news fair value gap before providing us the setup to target our buy side objective. Okay, let's look at an example of this. We see the 1050 macro here. You see macro opening price, and we see price spool below, which is what we want to see for macro power 3, run sell side liquidity, and look at how it's referring, okay, during the macro to that 10 a.m. red folder news fair value gap. Okay, so you're seeing time meet price. Yes, this is a BISI or a bullish fair value gap, but it's significant to us on the 1 minute time frame because it is the news fair value gap. So you're not only saying just focus on price, yeah, we're seeing it deliver off of a fair value gap. You're also internalizing and you have more confidence in it because you know it's the news fair value gap, and you're seeing time and price align here. After this setup occurs, we see price expand away. And the consecutive down close candles is your high probability order block. Okay, we'll talk about this in a separate teaching as well. But note how it's nested within this news fair value gap. The manipulation below macro open is complete. We referred to the news fair value gap, swept sell side liquidity, and we expand to a buy side objective. Let's continue forward for a bearish example here. Utilizing the news fair value gap as a macro reference point, we want to see macro power of 3, price go above macro opening price, refer to the news fair value gap, and then expand lower to our sell side target. Let's look at an example of this. We see Nasdaq's 1-minute chart, 950 macro, price aggressively expands above the macro opening price, running highs here, and look at what it's quickly referring to, right? This quick expansion. The 830 red folder news fair value gap. So you're looking for these signatures in price. You're asking yourself, what is the algorithm referring to during these macro time windows? It shows you what is significant. It shows you what is important, right? And we understand which ones are significant. That's why we have the checklist. 930 fair value gap, news fair value gap, macro BPR, etc., etc., etc. And we look for these levels to be worked during these macro windows, okay? After this gets referred to, after the manipulation above macro opening price has taken place, we're looking for our macro power of 3 entries. We see price expand lower, close below this BISI, and note how this is occurring during the macro. What does that make it? A bearish macro inversion. Our stop loss goes above the swing high, and we expand to our opening range relative equal lows. Okay, let's continue forward and look at how we can utilize the new week opening gap with macros and to our trading. Okay, let's talk about the new week opening gap as a roadblock. We're going to kind of speed it up here because I'm sure you guys get the gist of it now. When we're bullish, you want to see it close above the new week opening gap. We're utilizing the same logic for each one of these significant inefficiencies. Okay, the visualization, the same thing as the previous 2 significant inefficiencies. You're just replacing it with a new week opening gap. So this allows you, and your understanding of what fair value gaps are important from the significant inefficiencies list, this allows you to be flexible with price in terms of what the profile is for every day. Not every day you're going to have the new week opening gap in your trading as a roadblock, as a reference point. Not every day are you going to have a news fair value gap to work with, right? Not every day is the 930 fair value gap going to be a factor for you in your trade. But the fact that you understand them allows you to be prepared for when these situations do occur. Okay, so we're looking for the same signatures as the previous 2 examples. And let's look at an example in the chart. You see these 2 orange lines coming across your screen here, labeled on the right side. This is your new week opening gap. You see new week opening gap high, new week opening gap low, and we see the 2:50 a.m. macros. So this is an example for the London session. So you London traders inside of RTO, you guys can utilize these concepts as well. Okay, you see price go aggressively below macro opening price, sweep sell side liquidity. So the manipulation leg is taking place below macro open. After this occurs, you see a macro inversion closing above these 2 consecutive SIBIs. This is your entry model. Your stop loss goes below the swing low, below the macro inversion, bullish inversion in this case. And then you see that we have a buy side liquidity pool here that you can target more conservatively, but really see how that fell just short of previous day high. So this is engineered buy side liquidity. So if we're targeting previous day high, we're looking at what's in between our entry and our target. Well, it's that new week opening gap. So we want to see price close above as confirmation, and so we can move our stop loss to even. And look at how it supports price after we close above to our target. Beautiful, beautiful delivery. And this is the type of delivery you guys are looking for in your trading. Let's continue forward. We see a bearish example for the new week opening gap as a roadblock. The same visualization as the previous examples. Okay, let's go to a chart example of this here. Right, the new week opening gap, same orange lines, different example for Nasdaq's 1-minute chart. New week opening gap high, new week opening gap low. The 1:50 p.m. macro. Okay, so see how these are various macros. You just have to be patient and wait for the macro setup, the macro power of 3 setup to present itself. It's not going to be every macro, but once you're patient and you know how to identify it along with additional concepts in relation to a roadblock, for example, with a new week opening gap, you're going to be so patient and you're going to know exactly what type of setup and what type of delivery that you are looking for. So if we see the 1:50 p.m. macro, we see price go above it right here, sweep liquidity here, sweep liquidity once more here, refers to a premium inefficiency, and see how these consecutive BISIs were utilized to send us higher. We close below, high probability, bearish macro inversion, and this sends us to our AM session low. But the same thing, this new week opening gap was in the way from our entry and our target. So once we close below, we move our stop to even. We want to see the new week opening gap, a significant inefficiency, push price lower to our target. So if we continue forward, the new week opening gap as a reference point during a macro, we want to see macro power of 3 when we are bullish take place and refer to the new week opening gap below macro open. When we are bearish, you flip it and you want to see price refer to the new week opening gap above macro opening price. Okay, this is the visualization for a bullish example. You guys know at this point what we are looking for. Okay, so NASDAQ's 1 minute chart, 950 macro, price goes below. Look at this delivery, guys. You're seeing time and price meet. This is the delivery you're looking for. These are the signatures you're looking for. This is the respect you're looking for out of a significant inefficiency. Again, in this case, it's a new week opening gap. To the tick, it's going right to the low, right at the start of the macro, guys. Okay, this is your BISI and SIBI. Once we close above it, you're waiting for an entry, macro BPR. Your stop loss is the swing low below the macro BPR. You're targeting this opening range high. So instead of the roadblock with a new week opening gap, we saw here the new week opening gap as a macro reference point and beautiful examples of time aligning with price, which is what we want to look for as ICT traders and as RTO traders. These are the signatures. We don't just rely on price patterns. We understand the value of time. So if we continue forward, let's look at a bearish example of how we can utilize the new week opening gap as a macro reference point for a macro power of 3 setup. We see 950 macro, price spools above, and here, this is important, okay? When we are bearish for a macro power of 3 setup, we typically want to see what? Price in general go above it, but refer to a premium inefficiency and or sweep liquidity. Now, see how here, price isn't sweeping any liquidity, but it has an SMT. That's significant in and of itself. So this NASDAQ example, it's making the lower high relative to ES. So it would make sense for it not to have a liquidity sweep because the SMT is such a powerful signature in and of itself, but it's occurring during the macro. On top of this, guys, these blue lines here, that's your new week opening gap. You're seeing a macro SMT above macro opening price into a new week opening gap. This is the delivery you want to see. Okay, we have relative equal lows here in the form of our opening range low, which is also falling short of London low. So all you're waiting for is the entry model for macro power 3. And this is your bearish macro inversion. Right here, we close below it. The next candle, we wick up into it. Your stop loss is above the swing high, and you're targeting London's low. This is the type of delivery you guys want to look for. This is a high probability setup. This is why you want to be patient and not take the bait on the low probability setups that come so often throughout the day. There's more low probability, which you in your brain deem as a setup, or just convince yourself that it's a setup when it's not even there. There's more of those low probability situations than high probability. There's only a few high probability setups per day, if a few. Sometimes there's only one. But these are the signatures in price and the setup that you want to look for. So if we continue forward, how can we utilize the new day opening gap with macros? Well, it's the same logic, right? Let's first talk about and look at examples of utilizing the new day opening gap as a roadblock. Okay, let's get right into the chart examples here. So the new day opening gap for a bullish example. We're in the London kill zone and we're in the 3:50 a.m. macro. This is your macro opening price. Price goes below it, sweeps this lower time frame liquidity, but it's also sweeping yesterday's low. We close above this SIBI. That is high probability because see how the algorithm initially utilized it to push us lower? Once we close above, that classifies it as high probability bullish inversion. Okay, that's your entry method. Your stop loss is to swing low below this high probability bullish inversion, and you're targeting London's high here. Okay, now when does your stop loss go to even? You guys know now. These orange lines coming across your screen, that's the new day opening gap. Once we close above it, since we are bullish, that is when you move your stop to even, risk is reduced, and you let the trade play out. And see how price utilize this to find support and propel price to our target. Let's look at a bearish example with a new day opening gap as a roadblock, and let's get right into the chart example. Another London example, 4:50 a.m. macro, Nasdaq's 1-minute chart, price spools above macro opening price, sweeps buy side liquidity, comes below a macro inversion, okay, and delivers to our target. And this I'm seeing here, this was a good macro inversion as well. This candle, okay, I just missed this. So this should be the entry. This can be a pyramid, or if you want more confirmation, you are reducing your return in terms of handles, but the same logic applies, guys. So we see macro inversion, close below, entry on a retracement, your stop loss goes above this swing high here, and you're targeting this sell side liquidity. But what's in the way between our entry and our sell side target? The new day opening gap. Once we close below, even if it's this close to your target, right, you follow the same logic. Your stop goes to even. I'm sure you guys have been in situations where it gets real close to your target and then reverses against you and leaves this as, engineered relative equal lows, right? That can and will happen sometimes. Is it ideal? No, of course not. We want to see it go to our target, but we need to be prepared for those. And this rule, when we close below when bearish or above when bullish, a significant inefficiency of moving it to break even, your stop loss, this rule protects us from those situations and we're being responsible. Okay, so if we continue forward, let's look at chart examples of the new day opening gap as a macro reference point. This is your new day opening gap, 4:50 a.m. macro, working at the end of that London kill zone, macro opening price. Okay, price goes below it here, sweeps this liquidity into the new day opening gap. So it's referring to that below macro opening price, okay, and delivers us higher, high probability macro bullish inversion to the buy side target, stop loss below the swing low, below that PD array, okay. Continuing forward, let's look at bearish examples of a new day opening gap as a macro reference point. Again, guys, I know I sound like a broken record, but it's because these are the signatures in the high probability setups you guys want to look for. You guys know what inefficiencies are significant now. You know what's important, especially on the time frame that we execute on, the 1 minute. Look at all these PD arrays here and here and here and here and here and here, all these fair value gaps. Knowing which ones are significant helps you miss all these potential what you think are moves or silver bullets or 2022 models or inversions, whatever. You guys know that we're focused on the macro window and the significant inefficiencies. So here, during the 950 macro, right at the start, we spool higher, and look at how we're referring to the new day opening gap. We're referring to the new day opening gap. We close below it, and we come back up into it. Macro inversion, this is your entry. Your stop loss is going above the swing high here, and you're targeting the opening range low, okay? So again, as always, if you guys have any questions, let me know. You want to understand these significant inefficiencies. You want to look for these examples in your charts. Don't just take my word for it here throughout this lesson. You guys are going to start to see this, and you guys already have who have been in RTO for some time now. But in the future live streams and future reviews and, when we're watching price, you'll see how the algorithm refers to these levels during the macro windows. Okay, so take your time, review this, make sure you take notes. There's a lot of things to take in and really dig into the charts and do your own due diligence. I will see you everyone on the next lesson.